Hello, everyone. I'm pleased to welcome you to this webcast that will cover the transition requirements in Appendix A of the third edition of the IFRS for SMEs Accounting Standard. This is the final webcast in our series of webcasts to assist SMEs in applying the third edition of the standard. As this webcast will explain, the transition requirements specify how an SME transitions from applying the requirements in the second edition to applying the requirements in the third edition of the standard. We'll first look at the effective date of the third edition of the standard, which determines the annual reporting period in which an SME first applies the standard. Next, we'll provide an overview of the transition requirements before looking at specific transition requirements that apply to some of the amended requirements in the standard. Then we'll look at the disclosure requirements. Lastly, we'll bring together the key takeaways from this webcast. The third edition of the standard is effective for annual periods beginning on or after 1 January 2027. For example, if an SME has a December year-end, then its date of initial application will be 1 January 2027. But if an SME has a June year-end, then its date of initial application will be 1 July 2027. Note that an SME may apply the third edition of the standard at an earlier date if they wish. For example, an SME could elect to apply it to their June 2027 year-end. If an SME does elect to apply the third edition of the standard before the effective date, it would need to disclose this fact. The transition requirements are set out in Appendix A of the standard. In general, SMEs are required to apply the amended requirements in the third edition of the standard retrospectively in accordance with Section 10 of the standard. Retrospective application means that comparative information is restated as if the amended requirement had always been applied. Restating comparative information results in the SME's assets, liabilities, income, and expenses being presented on a consistent basis across all periods included in its financial statements. However, in some cases, it might be impracticable for an SME to determine the effects of applying an amended requirement for one or more prior periods. Impracticable means that the SME cannot determine those effects after making every reasonable effort to do so. In that case, the SME applies the amended requirement at the beginning of the earliest period for which retrospective application is practicable, which could be the current period. Also, some of the amended requirements in the standard have specific transition requirements which are set out in Appendix A. For example, in some cases, the SME might be required to apply an amended requirement prospectively, or it might be permitted to use a specific relief from retrospective application. We'll look at what this means in more detail when we look at the specific transition requirements. This slide lists out the sections in the standard for which there are specific transition requirements in Appendix A. We won't go through all these specific transition requirements on this webcast. Instead, we will focus on the key ones. You can use the list as a reminder to check the specific transition requirements in Appendix A when preparing to transition to the third edition of the standard. Let's take a look at some of the specific transition requirements, starting with those relating to Section 9, which covers consolidated and separate financial statements. Section 9 includes an amended definition of control, along with the amended requirements on assessing whether an SME has control over another entity, referred to as an investee. So, if an SME prepares consolidated financial statements, also known as group financial statements, the SME applies the amended definition of control and the related requirements at the date of initial application to determine which of its investees are subsidiaries to be consolidated in its group financial statements. In some cases, the SME might determine that it needs to consolidate an investee that it hasn't previously consolidated. In that case, the SME measures the assets, liabilities, and non-controlling interests, including goodwill, as if the investee had been consolidated from the date on which control was obtained. Alternatively, an SME might determine that it doesn't need to consolidate an investee that it had previously consolidated. In that case, the SME measures its interest in the investee as if it never consolidated the investee and had instead applied other relevant sections of the standard. As a result, the SME would remove the effects of consolidation and then look to see what other sections of the standard apply. For example, After applying the amended definition of control, an SME might determine that it doesn't control an investee, instead has significant influence over that investee. In that case, the SME adjusts its comparative information to remove the effects of consolidation and retrospectively apply the requirements in Section 14 on investments in associates. In some cases, it may be impracticable to adjust comparative information for all prior periods. An example could be for an acquisition that happened 10 years ago, and all the information to make 10 years of adjustments might not be available. In this case, the standard provides specific transition relief. This relief allows an SME to make those adjustments from the earliest period practicable, which could be the current period. Let's now have a look at the specific transition requirements for Section 19 on business combinations. Section 19 has been revised to align it with IFRS 3 business combinations. The changes include an amended definition of a business and amended requirements relating to contingent consideration. In contrast to the general requirement for retrospective application, the revised Section 19 is applied prospectively to business combinations that occur on or after the date of initial application and asset acquisitions that occur on or after the date of initial application. Because of prospective application, an SME does not make any adjustments to the assets or liabilities that it recognized in previous business combinations for which the acquisition date was before the date of initial application. Also, an SME does not adjust any contingent consideration balances arising from previous business combinations. That means no change is made to the amount of contingent consideration previously recognized but not yet settled at the date of initial application of the third edition of the standard. The transition requirements also carry forward the contingent consideration requirements from previous Section 19 in the second edition of the standard to ensure that those requirements continue to apply to previous business combinations. Specifically, if the business combination agreement required additional consideration to be paid, contingent on future events, and payment of that additional consideration is probable and can be measured reliably, then the additional consideration is included in the cost of the combination at the acquisition date. Otherwise, the additional consideration is recognized as an adjustment to the cost of the combination at a subsequent point when it becomes probable and can be measured reliably. We'll now move on to the specific transition requirements for Section 23 of the Standard. This section has also undergone major revisions in the third edition of the Standard to align it with IFRS 15 revenue from contracts with customers. This change to the requirements is likely to have some impact on most SMEs. However, the extent of that impact will vary from entity to entity. Entities likely to be the most impacted include those providing bundles of goods and services, such as retailers selling goods with warranties, and entities in the software, IT, and telecommunications industries. The change will also likely impact entities providing goods or services over time, such as entities providing professional services and entities in the construction industry. SMEs have a choice of whether to apply the revised Section 23 either retrospectively, which requires the restatement of comparative information, or prospectively, which does not require the restatement of comparative information. It's important to note that this choice is an accounting policy choice for the SME. So an SME is not permitted to apply the revised Section 23 retrospectively to some contracts and prospectively to other contracts. Retrospective application provides users of financial statements with more useful trend information because revenue is recognized the same way in both the current period and the prior periods. However, prospective application is simpler and less costly to apply, especially if applying the revised requirements would result in significant changes to the amount and timing of revenue recognized. So there is a trade-off to consider when making this accounting policy choice. If an SME chooses retrospective application of the revised Section 23, there are three optional exemptions available. If an SME decides to use an exemption, it must apply that exemption to all applicable contracts, not on a contract-by-contract basis. The first exemption permits an SME not to restate completed contracts that either begin and end within the same reporting period or were already completed at the start of the earliest period presented. A completed contract is a contract for which the entity has transferred to its customer all of the goods or services identified in the contract. In many contracts, an SME will have transferred goods when they were delivered and transferred services when they were performed. The second exemption also relates to completed contracts. It permits an SME to use a simplified approach to accounting for variable consideration. Specifically, an SME is permitted to use the actual transaction price at the date the contracts were completed, instead of estimating amounts of variable consideration for comparative periods. The third exemption permits an SME to use a simplified approach to accounting for the effects of contract modifications, in the case of contracts that were modified before the beginning of the earliest period presented. Specifically, the SME is permitted to reflect the aggregate effect of all past contract modifications instead of accounting for the effects of each contract modification separately. If an SME uses any of these exemptions, it must disclose that fact. In addition to these three exemptions, there is a disclosure relief provided for SMEs that choose retrospective application. Specifically, the requirement to disclose the amount of the adjustment made to each line item affected by the retrospective application is limited to the annual period immediately before the date of initial application. So the disclosure requirements of adjustments is not required for any comparative information provided for earlier periods. For example, if an SME provides 2 years of comparative information, it is not required to disclose the amount of the adjustment made to each line item for the second comparative period presented. As mentioned earlier, instead of a retrospective application, an SME could make an accounting policy choice to apply the revised Section 23 prospectively. In that case, as shown on the slide, how an SME accounts for a contract depends on when the contract begins. If the contract begins before the date of initial application, the SME continues to apply the previous Section 23 to that contract. If the contract begins after the date of initial application, the SME applies the revised Section 23 to that contract. Therefore, an SME that chooses prospective application might apply two accounting policies for revenue in the current period. It would not restate comparative information. There are also some other specific transition requirements for an SME that chooses to apply the revised Section 23 prospectively. First, there are amendments to the standard arising from the revised Section 23 that the SME is required to apply at the same time as it applies the revised Section 23. These consequential amendments are listed in paragraph A33 of Appendix A. Second, an SME is required to disclose that it has not restated comparative information, the nature of the change in accounting policy for revenue from contracts with customers, the accounting policy for recognizing revenue for contracts that were in progress at the date of the initial application, and the amount of revenue recognized in the current period for those contracts. Furthermore, an SME is not required to apply the disclosure requirements in the revised Section 23 to comparative information. Let's now have a brief look at some of the other specific transition requirements in Appendix A of the standard. We've listed a few of these on the slide. As you can see, the first three all require prospective application of the amendments made to the applicable sections of the standard. For example, an amendment was made to Section 17, Property, Plant, and Equipment, to specify that a depreciation method based on revenue is not appropriate. If an SME needs to change its depreciation method for an item of property, plant, and equipment because of this amendment, it applies the new depreciation method to the carrying amount of that asset at the date of initial application. For Section 28 on employee benefits, the retrospective application is required for the amendments to the measurement certifications for defined benefit obligations. However, no adjustment is made to employee benefit costs that were included in the carrying amount of assets before the date of initial application. For Section 30 on foreign currency translation, an SME is required to apply the amendments relating to a lack of exchangeability prospectively. Also, it is permitted to apply the amendments relating to advance consideration prospectively. Now let's look at disclosure. We've already mentioned a few disclosure requirements relating to the specific transition requirements we've covered earlier in this webcast. In addition, there are some general disclosure requirements that apply to transition. An SME applying the amended requirements of the third edition of the standard might need to change one or more of its accounting policies, in order to comply with those amended requirements. Section 10 sets out the disclosure requirements that apply to a change in accounting policy, subject to a couple of exceptions in paragraph A3 of Appendix A. The first requirement is to disclose the nature of the change in accounting policy. The second requirement is to disclose the amount of the adjustment for each financial line item affected by the change in policy to the extent practicable. Although Section 10 requires this information for both the current period and all prior periods presented, Appendix A provides an exemption for the current period. So the second requirement shown on the slide refers to prior periods only. The third requirement is to disclose the amount of the adjustment relating to periods before those presented to the extent practicable. The fourth requirement is to provide an explanation if it is impracticable to determine the amounts of adjustments. Lastly, Appendix A explains that if an SME has not restated comparative information in accordance with the specific transition requirements in Appendix A, then no disclosures are required about adjustments to financial statement line items. Finally, let's pull together what we've covered in this webcast and look at some key takeaways. In general, SMEs are required to retrospectively apply the amended requirements in the third edition of the standard. But there are exceptions to this general requirement. Therefore, when planning for transition, we suggest that an SME first reviews the amended requirements to identify those requirements that apply to the SME. For example, the revised section on revenue from contracts with customers is likely to have some impact on most SMEs. Then look at Appendix A of the standard to identify the transition requirements for each applicable amended requirement. There might be several things to consider. For example, as we have seen with the revised Section 19 on business combinations, in some cases, prospective application is required. Or there could be choices available, such as the accounting policy choice of whether to apply the revised Section 23 on revenue either retrospectively or prospectively. The result of this work will feed into the SME's transition plan. Let's look at what other resources are available to support an SME's transition to the third edition of the standard. The ISB published a project summary and a feedback statement and effects analysis alongside the third edition of the standard. It has also published a version of the standard showing changes since the second edition. The ISB technical staff is also updating the educational modules on the standard, prioritizing the sections with significant changes. These modules provide support to anyone learning about or applying the standard. Quarterly newsletters and a podcast series dedicated to the standard are also available. The newsletter summarizes news, events, and other information related to the standard. The podcasts offer bite-sized insights to support implementation. Finally, you can submit implementation questions about the standard at any time. You will find a link to submit questions on the supporting implementation page on the IFRS Foundation's website. And with that, we have reached the end of this webcast. As mentioned earlier, this is the final webcast in our series of webcasts to assist SMEs in applying the third edition of the IFRS for SMEs Accounting Standard. Thank you very much for watching and listening.